SF Desk Brief, Audio Deep Dive. January 27, 2026. Why silver's pressure has not cleared. Silver is higher today, but more importantly, the forces behind the move remain unresolved. Physical silver in Shanghai is clearing near $128 per ounce, while comex spot silver is trading near $112. That leaves a persistent, roughly $16 physical premium. That number matters. This is not a one-day dislocation. It's not a headline spike. And it's not speculative noise. It is a sustained gap between where real metal is changing hands and where the paper price is being printed. At the same time, inventories are reinforcing that message. Registered inventories in the Western system continue to be pulled, not rebuilt. Meanwhile, Shanghai inventories are not showing the inflows you would expect if this were simple arbitrage resolving the gap. Metal is not cycling back into the system, it is leaving it. That combination, elevated premiums alongside declining exchange inventories, is the clearest signal that price discovery has not finished. Monetary pressure adds to the imbalance. The dollar remains under stress and bond markets are not acting as a reliable pressure valve. Confidence is not moving cleanly into cash or treasuries. When monetary pressure cannot be absorbed by traditional paper assets, it does not disappear, it migrates. Silver is one of the few markets currently expressing that pressure clearly. Put simply, physical demand has not eased. Inventories have not stabilized. And monetary pressure has not let up. That tells us this move is not being chased. It is being forced. There is, however, one necessary caution. When precious metals behave as if a disorderly dollar breakdown is already underway, but most other real assets have not yet confirmed that signal, history suggests short-term misalignment risk, not thesis failure. In true currency dislocations, energy, agriculture, and other real assets typically reprice alongside metals. That confirmation has not fully arrived yet. This does not invalidate the structural case. It defines the timing risk. These phases are best understood as the middle, not the end. For long-term physical holders, these are periods to endure, not trade. For leveraged exposure or paper positioning, this is where volatility and drawdowns can appear, even when the underlying thesis remains intact. As long as physical silver continues to clear in Shanghai at prices well above the screen price, any consolidation should be understood as positioning stress, not resolution. Let's close with scenarios and probabilities. Scenario 1: consolidation with structure intact, approximately 45%. Silver consolidates or pulls back modestly as positioning resets. Volatility remains elevated, premiums stay firm, and inventories do not meaningfully rebuild. Scenario 2: broader asset confirmation, approximately 35%. Other real assets begin to reprice higher, confirming the monetary stress metals are already signaling. Silver holds elevated levels or advances further as confirmation arrives. Scenario 3: disorderly deleveraging, approximately 20%. A sharp, fast correction driven by forced positioning rather than improving fundamentals. Premiums may briefly compress, but physical demand reasserts if the imbalance remains unresolved. The bottom line is simple. This is not resolution. It is pressure expressing itself unevenly across the system. Physical silver is still clearing at prices the paper market has not yet absorbed. What happens next is not about belief or conviction. It is about how and when the rest of the system is forced to respond.